All right, let's talk about Bitcoin. You know, that magic internet money. The thing your cousin, the one who calls himself an entrepreneur but still works the closing shift at APPLBs, won't shut up about. For over a decade, we've been fed two completely opposite stories. Story number one, Bitcoin is digital gold. It's the future of finance, a revolution against the greedy banks, a lifeboat in a sea of government-printed cash that's going to zero. It's your one-way ticket to a techno-utopia where everyone is their own bank. Story number two, Bitcoin is a financial trap. It's a giant unregulated casino. It's rat poison squared, as Warren Buffett famously called it. It's a digital mirage that's only valuable because the next guy is even more foolish than you are. So, which is it? Is this the ultimate store of value, or is it the biggest, most brilliant scam of our generation? If you can't tell already, I'm deeply skeptical. And by the end of this video, I'm confident I can prove to you that while Bitcoin is a brilliant piece of technology, the industry built around it is the single most effective wealth transfer machine from the many to the few that the world has ever seen. Let's dig in. First, I want you to picture something. It's 2021. The world is on fire. Governments are printing money like it's toilet paper. A guy named Elon is hosting Saturday Night Live. Your friend, let's call him Chad, buys a Bitcoin. It costs him $60,000. He's a genius. He buys a t-shirt that says HODL. He tells you, have fun staying poor. Now, picture 2022. Inflation is raging. This is it. This is Bitcoin's moment. This is what it was built for, the perfect hedge. So, what does Bitcoin do? It crashes hard, all the way down to $16,000, a 75% drop. Chad is no longer a genius. He's quiet. Very quiet. His HODL t-shirt is in the back of his closet. Now, a picture today, late 2025. The ETFs are here. Blackrock is on board. The price is, well, it's all over the place, but it's up again. And Chad is back. He's wearing a new t-shirt. He didn't get smarter. He didn't learn a lesson. He just survived a catastrophic drawdown. He didn't use his Bitcoin to buy coffee. He didn't use it to escape a dictatorship. He just held on to his digital lottery ticket and is now screaming at you because his numbers came up. That, right there, is the entire crypto industry in a nutshell. It's not about utility. It's not about finance. It's about who can yell the loudest and hold their breath the longest. Before we tear it down, let's at least understand what the bulls are screaming about. Their argument is actually pretty simple, and on the surface, it's very attractive. It boils down to three key ideas. First, the scarcity argument. This is the big one. Unlike the US dollar, which the Federal Reserve can print into oblivion, and boy did they in 2020, Bitcoin has a hard cap. 21 million coins, ever. It's programmed into its DNA. It's mathematically enforced. The argument goes, gold is valuable because it's scarce. You have to dig it out of the ground. Bitcoin is valuable because it's scarce. You have to mine it with computers, and it's digital scarcity. This, they claim, makes it a perfect store of value. Second, the decentralization argument, the anarchy dream. No government controls it. No CEO can dilute it. No central bank can seize it. It's the people's money. This narrative was born from the ashes of the 2008 financial crisis, the very first block of Bitcoin ever mined. The Genesis block contained a hidden message. The Times, 3rd of January 2009. Chancellor on brink of second bailout for banks. See, Bitcoin wasn't just money, it was a statement. It was a middle finger to the entire traditional finance system that had just wrecked the global economy. And third, the halving argument. This is the secret sauce for the price goes up crowd. Roughly every 4 years, the reward for mining new Bitcoin gets cut in half. This is the halving. After the 2012 halving, the price went from $12 to over $1,000. After the 2016 halving, from $650 to nearly $20,000. After the 2020 halving, from $8,000 to over $69,000. The most recent halving was in April 2024. The supply of new coins got tighter. The bulls looked at their charts and said, buckle up. The rocket is fueling. For them, it's simple math. If demand stays the same or goes up, and the new supply gets cut, the price must go up. That all sounds great, right? a scarce, decentralized asset programmed to go up in value. So, why do I call it a trap? Because just like that Tinder profile your friend is so excited about, the reality looks nothing like the pictures. Problem number 1, it is not a store of value. It's a roller coaster. This is the most dishonest part of the digital gold narrative. A store of value is supposed to be stable. It's where you put your money to protect it from volatility. Gold does this, bonds do this. Bitcoin has an annual volatility of over 60%. For context, the US stock market is around 15%. Gold is around 12%. That means Bitcoin is 4 times more volatile than the stock market and 5 times more volatile than actual gold. Calling Bitcoin a store of value is like calling a bottle of nitroglycerin a stable paperweight. It's a lie. And here's the ultimate proof: the inflation hedge test. The one time in modern history we really needed an inflation hedge was 2022. Inflation was soaring. This was Bitcoin's Super Bowl. This was its one job. And what did it do? It crashed. 70%. It failed the test spectacularly. It turns out Bitcoin isn't an inflation hedge. It's the ultimate risk-on asset. It's a tech stock on methamphetamine. When the economy gets shaky and the Fed raises interest rates, people don't run to Bitcoin. They run away from it, screaming. Problem number 2, it has no intrinsic value. Let's get this straight. Intrinsic value means an asset has value by itself, even if you can't sell it. A stock has intrinsic value. You own a piece of a company with factories, employees, and profits. A bond has intrinsic value. You are legally owed a stream of cash payments. A house has intrinsic value. You can live in it. Even gold has intrinsic value. You can make jewelry. It's used in every smartphone, computer, and satellite on the planet because it's a fantastic conductor. Now, what can you do with a Bitcoin? I'll wait. You can't do anything with it. You can't use it to buy a coffee. It's too slow. The fees are insane. We're 15 years in, and the only real-world use case is speculation or illicit activity. You can't build anything with it. A Bitcoin is just an entry in a digital spreadsheet. That's it. Its only value is that you hope someone else, a greater fool, will buy it from you for more than you paid. This is the definition of a speculative bubble. It's the pet rock argument, and it's 100% correct. Problem number 3, the casino is rigged. So you decide to gamble. Fine, you go to the casino. But what if I told you the casino itself was a scam? Welcome to the crypto industry. You don't just buy Bitcoin, you have to buy it on an exchange. And those exchanges, that's the real trap. Remember FTX? It was the #1 exchange, the face of trust. It had Super Bowl ads, celebrity endorsements, stadium naming rights, and what was it? A complete and total fraud. The CEO, Sam Bankman-Fried, was literally stealing customer money to fund his own personal hedge fund, Alameda Research, and buy mansions in the Bahamas. When people asked for their money back, the entire $32 billion house of cards collapsed. And FTX wasn't the first. It wasn't even the biggest. Remember Terra/Luna, a stablecoin that was supposed to be pegged to the dollar? It collapsed to zero, wiping out $45 billion in 1 week. Remember Celsius? A crypto bank that promised safe 18% returns. Bankrupt, billions in customer funds, locked, gone. Remember Mt. Gox? The original Bitcoin exchange. Hacked, gone. According to the data platform CoinGecko, since 2021, over 3.5 million different crypto coins have been listed. And as of today, over 50% of them are dead. They've gone to zero. The crypto industry isn't just a casino. It's a casino where the dealers are actively stealing your chips. The building has no fire exits, and the government isn't allowed inside to inspect it. Okay, boomer, I hear you say. That's all old news. FTX was just one bad apple. The game has changed. The adults are in the room. You're talking about the spot Bitcoin ETF. In early 2024, the SEC finally approved them. Blackrock, the biggest asset manager on Earth, Fidelity, all their Wall Street buddies, launched their own ETFs. This was supposed to be the moment Bitcoin grew up. And in a way, It was. Billions of dollars in boomer money flowed into Bitcoin through retirement accounts. The price, after its post-halving surge, stabilized at a much higher level than before. But did this fix any of Bitcoin's fundamental problems? Hell no. It just put a new coat of paint on the trap. 1. It didn't fix volatility. The price is still insanely volatile. We've seen 20% swings in a single week after the ETFs launched. It's just a more accessible roller coaster now. 2. It didn't create utility. Does the Blackrock ETF let you buy coffee with Bitcoin? No. In fact, it does the opposite. The entire point of the ETF is to let you bet on the price of Bitcoin, without ever having to touch or use the actual coin. It just solidifies Bitcoin's role as a purely speculative asset. And 3. It kills the original premise. Remember that middle finger to the bank stuff? The be your own bank revolution? Well, guess who the single biggest holders of Bitcoin are now? The bank. The revolution didn't overthrow the system. It just got bought out by it. BlackRock is now the CEO of Bitcoin, whether you like it or not. The ETFs didn't legitimize Bitcoin. They just created a new, regulated, and highly profitable casino for Wall Street to sell tickets to. So after all this, we're back to our original question. Digital gold or financial trap? Here's the real honest answer. It's neither. It's not digital gold. Gold is boring. Gold is stable. Gold has intrinsic value. Gold doesn't care if Elon Musk tweets a dog picture. Bitcoin is the opposite of all those things. It's an anxiety-inducing, heart-pounding, high adrenaline asset. It's digital adrenaline is maybe, but it's not gold. And it's not a financial trap in the way you think. A trap or a Ponzi scheme implies that it must go to zero. I don't think Bitcoin is guaranteed to go to zero. The technology is brilliant. The idea of a decentralized, scarce asset is powerful. And as long as there is one person in the world who believes in that idea, it will have some value. So here's what Bitcoin actually is. Bitcoin is the world's first perfect global speculative asset. It is a brilliant invention that is 99% used for one thing: gambling. It's a social and psychological phenomenon wrapped in a technology burrito. It's a belief system. It's a digital tribe. Its value is not based on cash flows or utility. It's based on narrative and belief. The trap isn't Bitcoin itself. The trap is the industry that tells you it's a safe investment. The trap is the YouTube guru telling you it's a guaranteed 10 times return. The trap is the marketing that sells you a lottery ticket, but calls it an inflation hedge. My advice? Treat it exactly like you would a trip to Las Vegas. Don't invest in it. Don't put your rent money in it. Don't put your kids' college fund in it. And do not put your retirement savings into it. If you want to take 1% of your portfolio, money you are fully prepared to light on fire and watch burn to ashes and buy a ticket, go for it. You might even get lucky. But don't you dare call it a financial plan. And don't you dare call it gold. It's not the future of finance. It's just the same old human greed, the same old hype, and the same old blind optimism, just packaged in a shiny new digital wrapper.